Hey everyone, Longacres Finance here with the High Growth Dividend Stock Watchlist for May 2021. This is a monthly watchlist I publish here on my channel of the 30 best quality high growth dividend stocks. To be included in the watchlist, a stock must pass all the criteria on my stock screener. Then I rank all the passing stocks based on individual metrics and present to you the top 30 stocks each month. This watchlist is best used as a starting point for further research to give you ideas and companies to research for your portfolios. There are 4 new stocks on this month's watchlist, so stay tuned to find out who they are. The watchlist from April had a 6.71% return last month, beating the Vanguard Dividend Appreciation ETF VIG that returned only 4.03%. The 12 fairly valued and undervalued stocks from April had an even more impressive return of 8.36% last month. The S&P 500 total return last month was 5.34%, so both the watchlist and the fairly valued and undervalued stocks beat the S&P in April. If you're already a subscriber to the channel, welcome back. And if you're new here, consider subscribing so you don't miss future watchlist videos. Let's go over the May watchlist now, by sector. And we will start with information technology. There are 9 information technology stocks on the May watchlist, and they are Applied Materials, Intuit, Lam Research Corporation, MasterCard, Texas Instruments, Visa, KLA Corporation, Microsoft, and CDW. KLA Corporation is a new addition to the watchlist this month, and they have replaced Nvidia that has dropped off from the prior month. The average dividend yield of these 9 stocks is a low 0.91%, with Texas Instruments offering the best current dividend yield of 2.2%. The average 5-year dividend growth rate of these stocks is a very nice 22.08%, with Lam Research having the most impressive growth rate of 44.59%. The average payout ratio is a nice low 30.21%. Texas Instruments has the highest payout ratio of 57%, but that is still a respectably low ratio by my standards. Based on dividend yield theory, all 9 stocks appear to be potentially overvalued right now. Texas Instruments seems like the most reasonably valued stock, with its dividend yield about 7% off from its historical dividend yield. Up next are financials, and we have 8 stocks from this sector, and they are Charles Schwab, MSCI, MarketAxess Holdings, T. Rowe Price Group, Moody's, Progressive, Intercontinental Exchange, and BlackRock. BlackRock is a new addition this month, as the stock makes a return to the watchlist after a 3-month hiatus. The average dividend yield of these 8 stocks is 1.1%. T. Rowe Price and BlackRock offer more attractive dividend yields of 2% or more. The average 5-year dividend growth rate for all these stocks is a strong 20.99%, with Progressive having the highest historical growth rate. The average payout ratio is 31.04%, with all 8 stocks having a payout ratio below 50%. Based on dividend yield theory, Schwab and Intercontinental Exchange appear to be potentially fairly valued right now, while the other 6 stocks appear to be potentially overvalued. Up next is the consumer discretionary sector, and we have 4 stocks from this sector. They are Domino's Pizza, Lowe's, Home Depot, and Tractor Supply. No new additions, but we did lose Dollar General and Lithia Motors from the prior month's watchlist. The 4 consumer discretionary stocks offer an average dividend yield of 1.31%, with Home Depot being the only stock offering a dividend yield above 2% right now. The average 5-year dividend growth rate is a very good 18.13%. Home Depot and Domino's have the better growth histories, both above 20%, while Lowe's and Tractor Supply are in the mid-teens. The average payout ratio is 30.12%, with Home Depot having the highest individual payout ratio of about 50%. Domino's and Home Depot appear to be potentially fairly valued based on dividend yield theory, while Lowe's and Tractor Supply appear to be potentially overvalued. Up next is the healthcare sector, and we also have 4 stocks here, and they are United Healthcare Group, Thermo Fisher, Humana, and West Pharmaceuticals. Also no new additions, and none of the stocks have dropped off. The average dividend yield of these 4 stocks is a pretty low 0.58%, with United Healthcare offering the best current dividend yield of 1.25%. The average 5-year dividend growth rate is 14.36%, driven by United Healthcare and Humana. The average payout ratio is an incredibly low 11.06%, with United Healthcare being the only stock here to have a double-digit payout ratio. Humana appears to be potentially fairly valued based on dividend yield theory, with the other 3 stocks appearing overvalued. Up next is the industrial sector, and we have a total of 3 stocks here, and they are Cintas, Roper Technologies, and Expeditors International of Washington. Cintas is a new stock to the watchlist, and they replaced Northrop Grumman, that dropped off from the prior month. The average dividend yield is 0.76%, with all 3 stocks having current yields below 1%. The average 5-year dividend growth rate is 15.88%, with Cintas having the strongest dividend growth history. The average payout ratio is a very low 16.68%. All 3 stocks appear to be potentially overvalued based on dividend yield theory. Up next are materials, and we only have 1 stock here, and that is Sherwin-Williams. The stock offers a current dividend yield of 0.8%, with a 5-year dividend growth rate of 14.87%. It has a payout ratio of 24.4% and appears to be potentially overvalued based on dividend yield theory. And last but not least, we have our last new stock from the communication services sector, and that stock is Activision Blizzard. We have not had a stock from this sector since January of 2021, when Comcast made its final appearance on the watch list. Activision offers a current dividend yield of 0.51%. It has a 12.26% 5-year dividend growth rate and a payout ratio of 14.38%. The stock appears to be potentially overvalued based on dividend yield theory. There you have it, the top 30 high-growth dividend stocks for May 2021. All 30 stocks offer an average dividend yield of 0.94%, with a 5-year dividend growth rate of 19.04%. You may have noticed that none of the 30 stocks appear to be potentially undervalued based on dividend yield theory, and only 5 stocks appear to be fairly valued. This is the first month out of the 9 months the watchlist has been published that less than 10 stocks are either fairly valued or undervalued. Let's move on to past performance. As stated earlier, the watchlist has rocked a cool 6.71% return in April. The 12 fairly valued and undervalued stocks had an even more impressive return of 8.36%. Vanguard's high-yield dividend ETF VIG returned 4.03%, and the S&P 500 returned 5.34%. Since I have started tracking the watchlist in September of 2020, the fairly valued and undervalued stocks have performed the best, with a return of 23.93%. The entire watchlist trails this return by almost 5%, with a total return of 18.9%. VIG is right on the watchlist heels with a return of 18.67%, and the S&P is still ahead of the watchlist, but trails the fairly valued and undervalued stocks with a return of 20.41%. On a year-to-date basis, the fairly valued and undervalued stocks are also in first place, with a 16.05% return in 2021 thus far. The watchlist is in second place with a return of 11.88%. The S&P is in third place with a return of 11.85%, and VIG trails with a return of 8.77%. 7 of the stocks from the April watchlist had double-digit returns last month, and they are Domino's Pizza up 14.83%, MSCI up 15.86%, NVIDIA up 12.45%, Roper Technologies up 10.84%, Sherwin-Williams up 11.33%, Visa up 10.31%, and West Pharmaceuticals up 16.65%. Since I practice a buy and hold approach, I think it would be useful to show how such an approach would work in the entire watchlist, the fairly valued and undervalued stocks, and VIG. In April, the entire watchlist had the best return of 7.12% in the mock buy and hold portfolio. The fairly valued and undervalued mock portfolio returned 6.15%, and VIG returned 4.03%. On a cumulative basis since September of 2020, the fairly valued and undervalued buy and hold mock portfolio has the best return of 21.31%. The entire watchlist buy and hold portfolio still trails VIG by 0.44%, but has beaten the ETF during the last 3 months and is on pace to outperform in the near future. If you have any questions or feedback, leave a comment below. Thank you for watching.